Ladies and gentlemen, we indeed seen some of this rally that I predicted in the last video, bouncing from the bottom 362.17 on the S&P in between 5 and 10% over the next coming weeks. We returned 2.52% on the S&P 500 today, but we are still down about 10% from June 2nd, which was like 13 or 14 trading days ago. So we have a lot of potential room to bounce from here, or not so fast. We do have Fed Jerome Powell tomorrow, and that is going to be a major volatility catalyst, as the economic calendar does suggest it will be. Depending on what he says to Congress, could move the markets in a substantial way. And I kind of want to give you guys an overview of what I expect to happen, potentially what could be bullish, what could be bearish, go over the news for the day, the rest of the economic data that you guys need to know, and much more here in this video. So stay tuned and let's make that money. But in the meantime, before we get to the money part, hit that like button and subscribe to the channel. Also get yourself free stocks down below in the description. If you guys have not signed up with Moomoo, deposit $100, you will get 7 free shares just for depositing $100. That's the best return on your investment that you could possibly get, especially during a time where inflation is high and it seems like $100 is now a $20 bill. But nonetheless, let's get into it. So the S&P 500 was up about 2.52%. The NASDAQ was up more than that, and the Dow was up around 2.25% to close out the trading day today. And the only real reason why we've seen a bounce is textbook. And this comes back to the 5 to 10% rally from the lows that I expect to see. Yes, we did half of the low end range today, 2.5%. We get another 2.5% day. Boom, you're at 5% from the lows. But essentially, why we are rallying in the first place is not because we got really good news. It's actually quite the opposite, right? We got the bad news out the way. Even the bond yields today are going much higher. As you guys can see, the bond yields for the day did go up about 0.45%. So capital is becoming even more expensive here today. Things like mortgages, car loans, credit card interest rates, things like that definitely ticked up today. And usually you see stocks fall when cost of capital does get more expensive. But the reason we rallied, we got the Fed meeting out the way. We don't have any real earnings for the next couple of weeks. We don't have any real economic data for the next, for sure this week. We really don't have anything for this week. Next week we'll have a couple things, but nothing that's gonna substantially change the odds of a recession or the Fed going more or less aggressive as far as rate hikes. Nothing has really changed besides we got that fear catalyst out the way, which was the Fed, and we were sitting at the lows. Obviously we had the Fed meeting and we went up about 1.43% by the end of the day, and then the next day we fell 3.31%, and then the market started to chill out a little bit on Friday, eking out a gain of 0.22%, and then today seeing that 2.5% rally. So it's just a little bit of a relief rally because the major fear catalyst is gone, and because the markets have been so sold off. Even after a 2.52% gain on the NASDAQ, the QQQ, you're still down 30.02% year to date in the first 6 months, almost 7 months of 2022. So you've seen a lot of pain, and this is really all in anticipation of getting this recession. Now, I will say, depending on what Fed Jerome Powell says tomorrow, that could change things up a bit. If the Fed indicates they're going to go more aggressive, obviously that's going to be bad for equity markets. If the Fed does start to sound like, hey, you know, the economy is not doing so good, maybe they won't go as aggressive, or if they kind of hint towards maybe, you know, slowing down rate hikes in 2023, maybe the first couple of months, that will affect where the terminal rate expectations go, and that just means where the Fed will essentially stop raising rates. And those are really the two things that are going to move the markets in a big way. But I will say I do think lower lows are coming, but it's not now. When lower lows come in the markets, when you finally see a flush out and mass capitulation, obviously I'm sure you'll see bankruptcies, I'm sure you'll see hedge funds going under, specific businesses like Revlon. That was one of the first businesses to fail as of now, and pretty much everybody knows what Revlon is, the makeup company. So that was a pretty big deal, but I think there's a lot more of that to come. And when that's actually going to happen is when the Fed is raising rates during a recession. Historically, that like never happens. The only time that has happened is right here in 1974, as well as right here in 1980. Other than that, the Fed has never raised rates during a recession. And the times where the Fed did raise rates during a recession, you had very long recessions. Like this one in the 70s is equivalent, almost slightly shorter, but almost as equivalent as the 2008-2009 recession. Same thing in here in 1980, decent sized recession, and then a couple years later, 2 years later, not even 2 years later, about a year and a half later, you went through a very deep recession in the early 80s that lasted about 2 years as well. So it's never a good thing, especially when you have super high inflation and the Fed raising rates during a recession, and specifically when the federal funds rate is this low. It's never been this low heading into a recession in any form, right? The federal funds rate has always been higher. So we're really in uncharted waters right now, but I think that's when you start to see the mass panic, the mass capitulation, when people start to expect the financial system is going to collapse and the Fed is going to kill all economic demand forever. That's essentially when the markets bottom, and that's when we can start our slow and steady move back to the upside. The Fed is still reducing its balance sheet as well, and that is something to contend with. You've never had a balance sheet that was $9 trillion. You never had QE until after 2008, and the only time we started reducing the balance sheet was actually in 2017, 18, 2019, and that's where you did ultimately see about a 20% drop in the markets based off of almost purely that. So nobody really knows what to expect when the Fed wants to reduce the balance sheet by almost $1 trillion a year, and that is something we will have to stay tuned for, but definitely don't forget that, because that will come back into the equation later on throughout the rest of this year, if not in 2023. But I do think over the next week or two, you could see a pretty good bullish reaction just based off of how much we have sold off and the lack of fear catalyst that we are going to have. It's very well possible that Fed Jerome Powell comes out like he did just a couple days ago and says to Congress, hey guys, we're going to get inflation down no matter what it takes, and we are going to avoid a recession, or at least give us that kind of tone. That's going to be seen as a very, very bullish thing for the markets. Now, what I will say, in contrary to that, the margin debt is still very high. So the margin debt for May of 2022 came in at $752, almost $753 billion. And that's not down a lot from where we were in April. Even to start the year, January of 2022, we were at $829 billion of margin debt. We're only down to $752 billion in margin debt, but the NASDAQ is down 30% since 2022, since January. So what that means is you still have a lot of margin debt out there, but equity values have dropped a lot. So you're really close right now. Like if you've seen another 5 to 10% move down, you are going to see margin calls on a degree of which you have likely never seen before. And that could really overshoot us to the downside once you get those liquidations, and that is what will help set the bottom. So there is a lot going on as far as that. You can pick out different things as well, which could be good or bad, depending on what the Fed says tomorrow. We will see. The Fed meeting is actually 8:30 in the morning, where he testifies in front of Congress, answers questions, things like that, and that's where you're going to get the headlines, and that is what is going to move the markets. Now, on top of that, you have the Canadian inflation rate, not so important to our markets, but it still will be slightly important because we do the most trade out of any country with Canada. And then after the Fed at 11:50 a.m. tomorrow, you have Fed Evans that speaks. 12:30 p.m. Fed Barkin that speaks, and 12:30 as well. You do have Fed Harker that speaks. Some other data, some bond auctions, nothing too crazy. And then on Thursday, you do have Fed Jerome Powell again at 9 a.m. You have S&P Global Manufacturing PMI initial jobless claims, a couple other things, a lot of oil data, a lot of crude data that comes out, some more bond auctions, and then you do have the Fed Bank stress test results that comes out 3:30 p.m. on Thursday, and that is going to be the thing I think besides Fed Jerome Powell that could move the markets in a big way, because essentially what that is the Fed goes to the banks with this made up scenario of, I believe it's like 25% drop in the stock or 50% drop in the stock market, something absolutely wild, a 15% unemployment rate, all of these negative factors, and then they test the banks to see if they will be able to hold up and still be liquid in that kind of market environment. Usually the banks have done well, given where we were 3 to 6 months ago. Last time this bank stress test was done, they did fine. Well, this time around, the situation's a lot different. The liquidity levels are going to be different at banks, and if that is good, then that's going to be very good, because the last thing you want is everything else going to shit and then the banks also taking a massive dump. That's the last thing you want, is bank bankruptcies. So if that's good, it's going to be very good. If it's bad, if we show signs of a weak banking system, not going to be good. So keep that in mind. That does come out on Thursday. And then on Friday, you have new home sales, Michigan inflation expectations. That will actually be very important. Michigan consumer sentiment, Michigan current conditions, Michigan 5-year inflation expectations. All of that will be pretty important as well. But overall, Fed Jerome Powell is coming tomorrow, and there is going to be a big reaction. It is, like I said, highlighted in red, expected to be a high volatility catalyst. So nonetheless, that's pretty much going to be all for this video. If I were to point out anything and really what I expect, 5 to 10% move to the upside. I think you will likely chill out around 400 on the S&P 500, but don't be fooled. This is not the start of another bull market. We still have more downside to go, and even if the SPY does go up to 400, that would be almost a 7% move to the upside from here, but still would be down dramatically on the NASDAQ as well as the overall markets. And something else you do want to pay attention to is the price of oil, because that is going to be very important. That is up about 1% today. Brent crude up 0.71%. Why that is so important is because you need to see inflation peaking. And oil is not just the largest component of the CPI. It's affecting everything else. If you are a business, if you are just anyone, right, doing any kind of business, doesn't even matter if you're a mom driving your kids to school every day, or you're an Amazon, manager or whatever, or just Amazon, Jeff Bezos himself, you're affected by fuel cost in a lot of different ways. But these businesses, they pass that cost on. So the longer fuel stays high, the more inflation you will see. So I think that is a key to the stock market eventually bottoming. As we do start to head into a recession, then you will see the price of oil drop pretty substantially, and then the bond market as well. The 10-year bond at 3.28% is very high. It's at 2018 levels, breaking out, I believe, above 2018 levels, if not very, very close. And ultimately, when that does come down, that's going to be a sign of a recession, but it could also mark the essentially bottom for the stock market. And why that is a sign of a recession, I know somebody's going to ask that question, is because if you expect a recession, then you do expect deflation in one form or the other. And then at that point, why would you not take a 3.28% return when you don't know how good growth is going to be, but you expect inflation to come down during a recessionary environment? So once the bond yields actually do come down in a big way, sign of a recession, possibly could help mark a bottom. So that is going to be all for this video. Hit the like button, subscribe to the channel, source your comments, questions, or concerns if you guys have any. Thank you guys for tuning in, and I will see you in the next one.